Welcome, everyone, to the Firing the Man podcast. On today's episode, we have the privilege to interview Ismael Wrixen. Ismael is the executive chairman of FE International, the market leader in the sale of SaaS, e-commerce, and content businesses. Over the past decade, Mr. Wrixen has overseen over 1,000 successful acquisitions, totaling more than $500 million in value. Mr. Wrixen was also a 2018 40 Under 40 winner through the NACVA. Mr. Wrixen's previous background was a large cap M&A investment banker where he executed several high profile public deals, namely in the technology sector. Founded in 2010, FE International is known for its extensive network of pre-qualified international investors. With headquarters in New York and regional offices in Miami, San Francisco, and London, FE International is a growing company that serves clients worldwide. It was named one of America's fastest growing companies in 2021, and in 2020 was named one of the fastest growing companies in the Financial Times. We are incredibly excited to have Ismael on the show. So Ken, we just got done interviewing Ismael, and this was an absolutely awesome interview. What were some of your key takeaways?
Yeah, Ismael he's got a wealth of knowledge in the M&A and just in industry in general. And, a couple of my key takeaways, he spoke in depth about valuations and multiples. And it was really interesting to see the trending and where they are now and where they're going. As well as, I asked him direct questions on what between SaaS content and e-commerce, which one is the money flowing into, and to what he shares, the information is really exciting. You're going to want to stay tuned. David, what were your key takeaways?
The thing I really like about him is his exposure to entrepreneurs, right? After seeing over 1,000 deals going through, he has a tremendous amount of experience. And so we talked about the state of the e-commerce buying and selling industry. And I asked him a very specific question on market multiples, and he gave one of the best answers I've ever heard to explain this question. So anyway, stay tuned. Ismael, welcome to the show. First things first, tell us a little bit about yourself.
Yeah, thank you for having me. About myself, I am the executive chairman of FE International, which is a mergers and acquisitions firm specializing in, we specialize in e-commerce, SaaS and content businesses. So for the last 10, 12 years, that's really what I've been doing after leaving my investment banking career. Live out here in the US now. Don't regret moving at all. So that's kind of a very, very high level what I do.
Very nice. And how long ago did you make that transition from investment banking over to what you're doing now?
Yeah, I made the transition. I must have been close to 2011, 2012, which, yeah, again, a decision I certainly don't regret, making that switch over. It was nice because I got a lot of extremely good training from the kind of investment banking system, which is, if you're into finance and, those type of areas, kind of second to none from that perspective. But, myself and Thomas Smale, my business partner, we connected, we actually went to college together. And then from there, he went off, started our company now. After a couple of years, I realized, hey, this thing's, really going somewhere. It adds a lot of value. And then, I then left banking and came and joined him. So, it must have been 2011, 2012.
So Ismael, did you have any fears, like whenever you were so you had obviously a comfortable job in investment banking, and then you transitioned over? Was there any fears or did you regret not doing it earlier? Or?
Well, I honestly did it as early as I could, frankly. So at the time, it was, I think I'd done about 3, 4 years in banking, and that was the stage where I was starting to become kind of more associate level and above, which I think is where you have to kind of double down and really kind of decide, is this a long-term path you want to go through? Which and I enjoyed the very fast pace. I learned a lot. I was actually fortunate enough to work in the technology sector, which kind of back then was a lot more telecoms and those kind of things, as opposed to what we may naturally associate with technology today. I mean, the world has changed a lot over the past 10 or so years. But yeah, no, I wasn't really fearful, because my mentality was always, you can go and do it for a year, and worst case, you can come back. Nobody's going to judge you, within a year for, trying and maybe not 100% succeeding, and then kind of coming back and kind of, maybe trying again at another stage in time. But I definitely would have regretted not taking that step. So that was, for me, a very, very easy decision. And I remember kind of when I was speaking to my old manager at the time, he basically summed it up by saying, if you're going to go off and be an entrepreneur, there's nothing we can offer you that will keep you here, which was very true. That kind of path that you end up going down and, being your own boss and kind of building and adding your own kind of incremental value, that's kind of a journey in itself. So no, not a huge, other than having to pay bills in the early years and figure out now, later, now my job is mainly HR and making sure everybody else is happy, but it's certainly been a big transition. But yeah, I think the fears, once I jumped in with both, and I think that was the thing, I did jump in with both feet. So I didn't kind of leave, kind of try and do this on the side or anything like that. And I think that created a pressure of, well, this has to work, so let's put everything into it. But yeah, I think that may sound somewhat counterintuitive, but that made the whole process a lot less fearful because, I was fully 100%, invested.
Very nice. Now, would you consider yourself like a lifelong entrepreneur? For instance, like, did you have a lemonade stand when you were a kid? Or is it something that you kind of transitioned into following your investment banking career?
Yeah, I think I probably never gave my parents enough credit for, I think, some of the things they subtly taught me over time, because they, so I'm at, as you can tell, I am English. I'm also half French. So, they moved over from France to England with not a huge amount. And then from there, they just worked very, very hard, a lot of the time, and well, all of the time, frankly. And I would just see little ways where they would kind of, have, my mother had 2 jobs at one stage. So work ethic and those kind of items were always instilled from a very, very young age. But then, yeah, I wouldn't kind of say I had the lemonade stand, but I always, I thought kind of study would kind of, come in handy later in life. But I think I just had a very holistic way. I had a very holistic upbringing, and I think I have a very holistic way of kind of looking at the world and spotting opportunities. And I think that was probably very environmental with kind of the kind of family I grew up with. But yeah, I think that obviously growing up in England is a little bit different to the US. It's a slightly, obviously a lot of good businesses, a lot of fantastic entrepreneurs there. It is slightly less entrepreneurial in kind of culture. It's very much, that's part of the American dream, I would say, which I'm fully bought into now I live out here. I've been here for obviously a while, but yeah, I would say that it's something that I developed later in life. I think I just had very lofty goals, very high ambitions, and I figured that the banking side of things is great, but it's not going to give me the platform that I want or need to go off and get to that next level. Which, being an entrepreneur, especially a tech entrepreneur, in that space has certainly played out well.
Yeah. So you mentioned earlier, in the investment banking, you kind of were in the tech side of it. So you kind of learned a little bit, it kind of gave you a skill set to transition into your new role with. And then also you said something that I really like, and I want to touch on, is that you kind of jumped in with 2 feet. You're kind of like not looking back. You're like, I'm doing this and I'm just going to go for it. Do you have any other advice for, an entrepreneur that is getting ready to make the transition from, maybe a full-time job or whatever to being an entrepreneur? Any other advice that went along with that?
Yeah, I think it's just surrounding yourself with extremely positive people. It always helps, because it can be a very lonely journey, especially if you don't have, let's say, a peer set. And obviously there are fantastic networking groups out there and communities online today, which I would say didn't necessarily exist in the same format as it may have done 10 years ago, let's say. But I think that, one of the things, I do have a business partner, Thomas, and I think I probably don't give him enough credit for how much mental support and kind of bandwidth he actually helps us. And it's just a case of being able to bounce ideas off each other. I think that's useful, but it doesn't have. But you can get that from multiple people. It can be a spouse or a family member or just peers, colleagues. I think that has been very, very helpful over time, because I'm a reasonably assertive person. If you do those kind of personality tests and those kind of things. But at the same time, there is always that niggling in the back of it, like, is there another way to do this? Am I maybe not seeing something that other people are seeing? And I think when you take that, both feet in approach, like I said, it has to, the idea then is that it has to work. You don't necessarily have that safety net, which I think makes you think in a slightly different way to, let's say if you had the safety net of, still having a job or having lots of kind of VC funding or whatever, or kind of whatever else it may be, you may make slightly, different decisions, along the way that aren't necessarily always as long-term they're thinking. And with that, I think that the more people you can have around you, if you don't have that safety net, the better, because an opinion is always, whether you choose to exercise that opinion or not, it's always valuable, at least to see how other people can take the same information maybe in a different way. And sometimes that can just bounce back and forth. And Thomas and I over the years have locked ourselves in rooms for days in some context until we get to the bottom of something. And just having that support, in terms of a peer has been excellent.
Well, very nice. Looking at your journey, we call it firing the man, right? You were working for the man and you fired the man. Do you regret not doing that earlier, in terms of timing your exit?
Yeah, I mean, I think so. We with our business, I mean, we kind of have bootstrapped and kind of reinvested over time. So I think in an ideal scenario, because there is that compounding nature of growth, which once the train takes a lot of effort to get out of the station, then once it starts moving, it's very hard to slow down. So obviously, I wish I could go back even further and be further ahead than where we are now. But I think I pretty much did it as early on, in my kind of banking career as I could to make that jump across. But I wouldn't say that there's an optimal time for this. It has to work on many levels, and I think you have to be personally ready to make that that jump and commitment. I didn't have at the time I didn't have a family. I didn't have a huge level of commitments outside of that. So I mean, quite frankly, the risks I took back then I probably wouldn't take today in exactly the same I would do things slightly differently. But yeah, I mean, I think you can kind of take that leap and that jump at any stage, really. I think what I know now compared to, let's say, 10 years ago is vastly different. And I'll probably say the same thing again in 10 years. So no, I think the key was just taking that, just starting somewhere and just doing something, and taking that step was and now we're here.
So Ismael, appreciate you sharing your story with the audience, and it's inspirational, to be honest with you. So I'd like to pivot a little bit and get into FE International. So can you explain what FE International is and how can it help the listeners?
Yeah, absolutely. So we are an M&A advisory firm. So we work with a lot of founders, and I guess for context, we've helped over 1,100 founders exit their business at this stage. And I would say we deal in anywhere from kind of 0 to 100 million is really kind of our comfortable sweet spot in terms of what we do. We very much specialize in e-commerce, SaaS, and content businesses, though. And we focus very, very early on in our journey, kind of in those areas. And that's ebbed and flowed over time. There was a period, in the 2010 to 2013, 14, where content was extremely popular. Then it became a bit more SaaS. And now, obviously, a lot of the investor money is moving much, much further towards e-commerce, FBA, and which, obviously, Amazon as a platform, only the last 5 or so years where, in terms of the amount of revenue they're making from third-party sellers has really started to ramp. So in turn, the interest across the sectors have followed suit. But I mean, in terms of what we do, we tend to work with bootstrap and kind of self-funded owners who may have had the door shut on them or not necessarily have the exposure to the kind of traditional kind of finance or banking advice from kind of the bulge bracket, investment banking firms. And we really are here to help with, valuations, exit planning, optimizing, and then taking businesses out and actually helping people go through that acquisition process. So I would say we work with the kind of, founders that we work with. It's usually about, I would say, 6 to 12 months potentially of work before actually going through an acquisitions process, because there's always optimization that can be done. There's always value that's being left on the table, because when you're in growth mode, that's very different to optimizing ahead of a sale and, you know, shoring everything up and making sure the business looks, you know, as good as it can be. Because growth mode, you will just reinvest. You should just be continuously reinvesting. Which is a lot of experimentation, a lot of trial and error to see kind of exactly how far you can push the business. So sometimes there is a bit of optimization to be done between that and actually then going out and selling. So we do a lot of that initial consulting, valuation, exit planning, and then ultimately the sell side M&A as well. Very
nice. Now, I'm very interested in your answer to this question, having seen 1,100 companies be bought and sold. If someone said, listen, tomorrow you need to go out and buy a company, and you have the option of picking a content company or a SaaS company or an FBA company, describe what that company would look like in terms of, you know, where do you see over the next 5 to 10 years there being serious opportunity?
Yeah, I think that you have to, you know, there is a lot of money that has been flowing into that FBA. I think, you know, just within our network, I mean, we polled it the other day. I think we have close to $8 billion now in, you know, dry capital just assigned to e-commerce and FBA businesses in general. So that's sort of about 26 billion or so. So, I mean, that is a growing number. And I think that if you're looking to start a business and you're looking to, you know, or acquire a business, as you said, you know, I think that you have to take that into consideration, because you know, there are a few certain things in life. One of those things is going to be that if you own a business, one way or another, you are exiting that business. So you want to make sure that there's a good amount of demand for whatever it is you're potentially getting yourself into. And then obviously, you know, that same thing can apply in SaaS and content as well. I mean, content has been getting more and more difficult just because Google keep updating the algorithms, keep changing the game, and good and bad, because it means that there are fewer businesses, the multiples go up in time, but it means that you know, if you're buying in that space, you will be acquiring theoretically higher and higher quality assets over time. SaaS is obviously extremely attractive to the predictable nature of the revenues. I think, you know, it can be highly technical. So, you know, it's not necessarily something that's, you know, for the one person with a very small team in some contexts to kind of take on and roll with. So you are usually inheriting kind of, you know, teams that are in place, and there is a lot more kind of, I would say, HR and management, and, you know, the more kind of traditional things you would sometimes associate along with running a business, along with a lot of technical growth and knowledge you need as well. And that's why I think a lot of people have been pivoting, you know, their interest and time towards FBA and towards, you know, other e-commerce businesses that have solid 3PLs in place, because ultimately a lot of that burden and responsibility is taken off your hands. You know, Amazon itself is a search engine at this stage. So, you know, and it has you know, obviously it's native ad platform and obviously review algorithm and everything else that goes in with that as well. So if you're looking to take a business and scale it profitably over time, I would say that FBA and e-commerce in general is a great place. And obviously, you know, pandemic, horrible for many, many reasons, but it has been the e-commerce after the initial blip of inventory and supply, which, you know, is Port of LA was still having problems. But I would say the sector has exploded over that period of time. And I think that is now a behavioral change that is just going to continue into the future. So we would expect this industry to keep growing. So, but yeah, more specifically, I would dive in on evergreen businesses, things as close to the home as possible. Anything kitchen related or around there is kind of where we're seeing, you know, a lot of interest over time, and where the end, obviously, you only get limited data, you know, working with Amazon, let's say, for example, where the end user, you know, where you do have information, you know, there may be other things and products within a similar category. You can continue to sell to them over time to increase their lifetime value. I think that those are the kind of, you know, businesses that I would personally be most focused on.
Interesting. Follow-up question on that, Ismael, is, you know, if someone came to your team and let's say they recently left corporate America, you know, and they wanted to just go out on their own. Say maybe they had, you know, 500,000 to maybe 5 million range of funding. Which business model, from SaaS, content, or e-commerce, which one is, like, let's say the easiest to run, you know?
Yeah.
In your opinion?
No, I would definitely say that e-commerce. I mean, there are some very highly technical elements within that, especially given a lot of them have a very high kind of PPC spend. So you kind of need to know what you're doing with that. But obviously, if you're buying a business, then you at, let's say, the 5 million and above level, you would expect there to be a very solid strategy in place, and that would be part of your kind of your diligence that you're doing before acquiring the business. So you would expect to inherit a lot of, obviously a lot of the business, the brand, the goodwill, and the products, and everything that goes with that as well. But hopefully some talent that would come with it at that level and above. But yeah, I mean, I would say that that's where, if we just look at the volume of new inquiries that we get from potential buyers wanting to join our network, then I would say that that is the space where we're seeing the most amount of interest. And I think for good reason. It's becoming easier and easier to kind of use the platform over time. I think Amazon itself has actually done a reasonably good job of shoring up its own policies, and I know there are still issues over time, and there are fringe cases and all sorts of things that happen. But compared to 5 years ago, I think that now with kind of the gating and everything else, I think that it is kind of generally moving in a better direction over time as well. So yeah, I mean, like from an investment perspective, I'd say that's a very good place to be putting capital. But obviously, it comes down to the kind of deal you're getting, and there's risk in every business, and that needs to be structured in. And that's not just on the buy side. I mean, it helps on the sell side as well, because the multiples are going up over time, and that's being driven by a lot of aggregators, a lot of other players coming into the space. And as those multiples move up, business owners looking to exit need to understand as well that you can get these higher multiples, but there needs to be some sharing of the that burden of risk over time as well. So yeah, I think that that's kind of generally the area that I'd be most focused on. But within that itself, I think it then comes down to a business by business basis, because no two businesses look alike. Even if they selling very similar products, or you think they're very similar audiences, they can be set up in extremely different ways, and that is going to categorize how you kind of risk things in and move forwards.
You were talking about multiples, and I'd like to dive in here and just a little bit of background on this question. I spent 8 years in transaction services before I fired the man. And while I was doing that, our typical client was a private equity fund that was, say, buying a manufacturing facility in rural Ohio. And that type of company would typically trade at like 7 to 8 times EBITDA. And when I started getting into this industry, obviously they're valued on sellers' discretionary earnings. For purposes of this question and for the listener, basically the same. 3 to 4 times sellers' discretionary earnings. It seems like there's kind of a disparity between e-commerce companies and like your traditional brick and mortar. And when I think of those differences, obviously the balance sheet is going to look a little bit different. For instance, most of our portfolio companies, the only assets we have are inventory and our computers, right? So not really an asset intensive type of business in terms of like fixed assets. But do you have any explanation for like that disparity, or am I off here? Do you think?
Well, I mean, I think that the multiples have been moving up. I mean, we're seeing deals mainly, I would say, in the 4.5 to 6 times in some cases. It really depends on how competitive the process gets. I mean, I think that's kind of one thing. I think a lot of people have potentially been leaving value on the table by getting approached and selling to the first person that wants to have a conversation with them. So I think that there is a lot of value in kind of that competitive scenario. But then at the same time, the businesses are offline versus online. In that context, there are a lot of differences in those. I mean, I'm not sure kind of what was on the balance sheet of those businesses, whether that was incorporated, within those kind of, obviously not on the EBIT multiple side, but in the wider transaction that may have kind of diversified the risk of the whole deal versus the risk of online deals. And ultimately, in the kind of brick and mortar, you are not on somebody else's platform at the end of the day. They can kind of change the rules. So that's kind of something else to consider. But then I think one of the wider components, and this doesn't just go for e-commerce or FBA, this goes across the board, I would say, is the scale that's been achieved. I think that's kind of one thing as well. If you're a business that's managed very successfully to get to a high 6, 7 or low 8-figure valuation, that's obviously fantastic and one thing, but the scale, what may be required to take it to the next level could be a huge amount of working capital that you may not have. So somebody may come in and look at that and go, okay, I can take your $10 million business and I can turn that into a $50 million business, but that's going to cost me $10 million in working capital on top of the acquisition price. And I'm not going to pay you an additional 3x multiple on top of the 5 I'm giving you, for example, for the privilege of doing that. So, because I'm burdening the risk to actually then go off and do that myself. So I think that's where a lot of it comes into, because when we get to the, the mid 8-figure and above deals that we represent, I mean, the multiples are closer and sometimes higher than what you are discussing there. So it depends where you are on that scaling journey and then how much additional is going to be required. Because the thing with buyers is, I mean, and buyers are extremely savvy. They look at things from an ROI perspective, but not just how much did I pay on the way in, how much am I getting on the way out. They're looking at the IRR. So they want to see kind of the internal rate all the way through, and how much of the growth is going to be supported by the business, how much of the growth is going to be supported by additional working capital, how that whole investment across the life cycle of the acquisition benchmarks against weighted average cost of capital, time value of money, other opportunities that may be scaling faster or slower than the business that you're running. So all of these things really factor in when it comes to setting that multiple. And the more you're scaling and the less capital intensive that scaling is, then that's where, and the more that can be supported by the business's existing operations, that's when you're going to start getting those kind of, like I said, 5, 6 and above multiples, which does, and it does scale and it does keep going depending on where you end up.
Yeah, so Ismael, I'd like to. So David and I, we went to a Prosper show last month, and it was pretty well noticed that there was aggregators are exploding right now. Precio through a Bash at Bellagio, and so there's money freely flowing in. Right now, do you think the competition of the aggregators is pushing the multiples up higher, or do you think there's just the market itself is so much more opportunity of e-commerce penetration, or is it a combination of both?
I'd definitely say it's a combination of both. I think the multiples are pretty stable for a while, around that 3 to 4 times mark, I would say. Then the aggregators started coming in, and they've been there for, I mean, you talk about Thrasio, for example. I mean, we, obviously, we know them. We've been dealing with them for 3-4 years, so they have been ramping up their activity over time, and obviously raising more and more as they go. But I mean, they were obviously very early in the space. I say now we probably have 120 to 150 aggregators, from all over the world. A lot in Europe that are cropping up now as well. So there are a lot there, and what you tend to find is that obviously the bigger names will continue because they have a different strategy at this stage. A lot of them are looking to go public, so they need to keep buying businesses, and I completely understand why. But then you have a lot of smaller aggregators, or kind of, I say they're not small, but newer aggregators that need to play catch up. So they are less sensitive to multiples than they may allude to being, because just they realize that they're a year later into, or a couple of years later into the game, and therefore they need to be acquiring businesses at a faster rate to kind of to bridge the gap. So I think that there is kind of a second wave of this aggregator market coming along, and that's going to keep pushing multiples up for a little bit. But I would say that there's a lot of other interest as well. And what we're seeing is, especially on the private equity side, we're seeing private equity firms that, there's obviously aggregators kind of fall into that. We're seeing other types of private equity firms that may have portfolios in the content space, for example, and they realize, hey, we can actually bolt on FBA businesses, and instead of using Amazon's affiliate program, we can start swapping some of that out with own brand products that we then own. And so there are other pockets of value being created there as well. Obviously high net worth individuals, and I would say they usually cap out at about 5 million, which is incidentally where the SBA program caps out, and lots of other reasons, but they've always been there, they will always be there. And then obviously there are the more strategic as well. So I think there are a number of reasons. I would be more concerned if it was just, listen, there are 10 aggregators and they're pushing everything. That's where it kind of creates a bit of a more risky scenario, especially from a buy-side perspective. But no, I think that there is a lot more depth to what we're seeing at this stage. And does that mean in a year we're talking of higher multiples? Maybe not. I mean, I don't think that it's just going to keep going forever in that direction in quite such a linear path, because a lot of, and we saw this in SaaS actually, about 5 or 6 years ago, there were a lot of SaaS aggregators, in the kind of 2015, 2016. They were very aggressive with acquisitions, and then they slowed down a little bit. And then they started to focus on the operations and making sure the synergies they thought they were acquiring are actually operating as well as they were. So, the bigger names will probably after a while start to slow down a bit. There's a second wave of kind of other names coming through now in the aggregate space. PE and other forms of strategics are picking that up as well. So I think that there is good depth and stability to the increase we're seeing.
So just to follow into that, so earlier, you're saying the Amazon FBA native or pure FBA businesses are trading in that 4.5 to 6 range. Was what you're seeing recently?
Yeah, I would say, and depending on the type of business, that will also depend on whether that's more of a historic multiple, a right here, right now, or sometimes a forward-looking. So if the business has very little seasonality in it, and there are some businesses and some niches that have very little seasonality, sometimes you can then use a little bit more of a forward-looking multiple in that calculation. So, and there are a number of ways to value businesses. You have discounted cash flow modeling, historic price regression, revenue regression, comp analysis as well. So, really, when you work with an evaluator like us, we will look at multiple kinds of models and figure out which one is most applicable to your business, depending on kind of lots of factors, but growth rate is going to be one of them. Concentration around different types of SKUs, different times of year, it is going to be another one as well. And where there's a lack of those latter two things, that's when sometimes we will end up using more of a forward-looking number. So that 5 times more forward-looking could actually be 8 times historic. So really does depend. And that's why I always recommend, having conversations with advisors early on, well before you're thinking about exiting, just to get a sense of where exactly your business falls, so that you know what to really focus on, 3-6 months before taking an exit more seriously.
Very nice. Now, in terms of like prepping for an exit, say somebody was, wanting to exit a business in a year. What are some things that they can be doing now that are going to make that exit, when they reach that point, smooth and, hopefully capture as much value as possible?
Yeah, great. I think that obviously read built to sell. That's always a good starting point. But no, I think a lot of things, it depends on the scale of the business. If you are running a, let's say, $0 to $2 million, value business, you are probably going to be heavily involved in that company. You may have some staff that you're working with, maybe kind of a couple of different managers, certainly on the PPC side, or on the marketing, on the kind of operations. You would hope to have at least, and customer support, you'd hope to have kind of something in place, even if it's not full time. You would have kind of some kind of resource. But that's, beyond that, you should really be, trying to get yourself out of the business beyond the strategy and visionary thinking as possible. I think founders do a reasonably good job of that anyway. Sometimes when they speak to us, we give them that extra push they need, because we can show them a lot of data to say, actually, you're in a very good company. Here's the step. Here's how much you should be spending in these areas. Here's where you maybe over-optimize or under-optimize it, and how exactly to go about it. So I think taking yourself out, when it makes sense from a value perspective, I think is one thing. I think the other kind of practical thing is just having the financials in very good order. I think it's very, very common for us to speak to people and say, the initial conversation, they say, listen, we're doing this much revenue, here are our gross margins, here are our net margins, and then you get in and you're like, this is completely wrong. So and that's where it's not just to make our lives easier, it's also, if you have a very accurate sense of where your financials are at any given point in time, you will make you theoretically will make better decisions as you go on how much you want to reinvest, versus just looking at, let's say, the bank account and how much free cash is left at any point in time. So I think that when we start to get into conversations about how profitable a particular SKUs, how much concentration is around certain kind of SKUs, and where should you be kind of reinvesting the most heavily, I think that's where a lot of people are sometimes, and I get it. I run a business as well. Sometimes it's a case of, well, it's working, so let's not kick the hornet's nest too much. But once you start, because we will dig into all of that, and we will sometimes show you, look, these are the areas that you're valued at this level now, but you could add multiple millions of dollars if you just spend another 6 months focused. And that's to your point about, could you have started sooner if people have that in place and that accounting and that reporting. And I think a lot of people just rely on QuickBooks and they rely on Xero, the information that goes into there, but the information is only so good as the input you have. I would say the first thing we do is, and I'm not going to suggest everybody does this, but we will always switch cash flow, to accrual accounting, and then you can actually start to dig in to see the underlying true profitability of the business. And sometimes people realize, well, actually, based on that, I will make this decision or this decision. And I think that's an area that the sooner people get started and have a good bookkeeper and good CPA, I think that's always that's not a decision anybody's going to regret.
So Ismael, there was a question that was posted in one of my masterminds that I go to, and it was, can you speak to, like, let's say, so you mentioned earlier there's upwards of 120 aggregators worldwide now, and they reach out. So David and I, all business owners on Amazon are getting emails pounded weekly. And so can you speak to the benefit of going to a broker versus going directly to one of these aggregators, and why it's beneficial, and maybe even put some hard numbers to, because people are like, oh, the broker's fee. Well, can you think about that a little bit?
Absolutely. And it is a good strategy by them. And I think that the aggregators, they're not necessarily doing it in the sense of, if we go, privately, we can get slightly better deals all the time because they're cutting out the broker. They just realize that to hit the volume they kind of need to hit, they may or may not, get that through going through advisors every time, because we are a little bit slower in our approach, and we're a bit more considered, and we want to run a competitive process because ultimately our client is the business owner and it's the seller. And if it takes an extra couple of weeks or months to run a competitive process but you get more out of it, we're very happy with that, and so are our clients in the end. But these aggregators will, they have been reaching out, they will continue to reach out. I would say one of the challenges that we hear a lot is that, so people will get approached and then they'll realize, okay, my business does have a value. It's not just me that sees this. I will consider, selling it. And that affirmation kind of sometimes gets the ball rolling, mentally with the thought of exiting. And one of the things that we see a lot is, the initial offer comes in, the promises are very lofty. We're not really going to do that much diligence. We have our own team. Don't worry about it. We'll get this done in 2 to 4 weeks from signing an LOI. And then from there, it starts to crack a little bit. And then once you're signed, then, they may have other obligations because, you're not the only conversation they're having. And their time needs to be kind of firmly focused front and center. And if you're not running a competitive process, then that's where it may be challenging, because you're in a one-horse race at that stage. You have a buyer, they have a level of exclusivity. There is sunk cost fallacy with it as well. You are continuing to invest time and give them more and more information. So you're either feeding them a bunch of information they could eventually use against you, or you're pushing yourself further down this path, which means that ultimately, after the 3rd, 4th week, when they need to extend it by a couple of weeks because of today's reason, that's where you'll just keep going, and your business grows during that period. It may be worth, depending how long it takes, could be worth more money. And if you don't have somebody, firstly running a competitive process, keeping them honest, always having that threat of, well, there are other buyers who would want this if you step out of line, or if you're not kind of adhering to the terms of the LOI we agreed, or pushing things in the right direction. And one thing we will do, obviously, we audit every business before we go to market. So we have very little concern that there are going to be financial issues coming up in due diligence, but we also have general counsel in house. So we'll push the legal aspects of it, so that if we know there's a legal issue, we don't need to find that out after, 4 weeks of due diligence. We'll find that out after 4 days, because we have a separate team negotiating with their legal attorneys to make sure that everybody is on the same page about the multiple facets of here to actually closing. So I think there's a lot of value. I think that, I think it's a bit of a false economy when people say, well, I'm not paying the broker fee in this context. It's like, well, you don't know how much money you're leaving on the table. And I guess we've actually got deals done. So with some of the aggregators we've spoken about, we have got deals done where they've actually had conversations with a business owner, before the conversation may or may not have gone anywhere. And then we actually kind of get to the bottom of what the business is really worth, present the information properly, have the data, have all the financials audited and the very clear growth opportunities, and then take it back to the same aggregators and they say, oh, actually, we do really want this business. Like, now we see it in this way it's being presented. Obviously the owner was very busy in that particular context and couldn't always get the information. And it's a lot to try and manage the growth of your business, especially, going into end of Q3, Q4. There is a very important time of year. You take your foot off the gas and suddenly that offer can disappear. So that's a lot to manage in itself. And yeah, I mean, in that particular case, we got the deal done. We actually got it done with a different aggregator, which was a nice, nice to stick it to them ultimately. But that went particularly well for the owner there. But the competitive process really adds something, because if you want to focus on aggregators, I mean, they really, it's a land grab for them. They have to be buying as many good businesses as possible, and ultimately the cost for them, the smoothness of working through an advisor versus doing everything privately, they're not doing the hand holding the whole way, which means the negotiation leverage is on our side, not on their side, which means the offer is one bit. That's relatively easy. You can go and get an offer tomorrow if you really want one. The offer through closing is where we earn our fee, and making sure that, the terms don't change, that, things actually get pushed through timely, smoothly. And then often these deals have performance elements. So we don't just disappear the day that the initial deal is done. We're there, doing all the accounting, doing all the reconciling, so that everything, no matter how long it takes, and whatever is agreed, is ultimately paid to the business owner, which is, something that we assume responsibility for, because we're a partner in that journey. So, it's in our best interest, in our client's best interest.
All right, Ismael, we're going to move into the fire round. Are you ready?
Yes, I think so. Let's find out.
Oh, all right. What is your favorite book?
It's The Goal by, I'm probably going to butcher the name, Elia Goldratt, which I think is about 40 years old now. But it's about the notion of continuous improvement, and actually highly relevant for e-commerce in general, because it is actually set in a manufacturing facility, and kind of, oldie but goldie, I would say, with that book.
Okay, awesome. I've not read that. I want to put it on my list. What are some of your hobbies?
I've recently, very unsuccessfully, taken up paddleboarding. That's not going so well. Yeah, a lot of face first in the water, but it's harder than it looks. But I have a reasonably outdoor. So I have a couple of dogs, so we're always outdoors, kind of biking and those kind of things. It's just nice to get away from the computer screen for half an hour every now and then.
Awesome, absolutely. And yeah, my girlfriend talked me into doing that paddleboarding once, and that is some core strength right there.
It really is. Yeah, I refused to try yoga, so I did that as a compromise, and it's
that's awesome. All right, what is the one thing that you do not miss about working for the man?
I'm a bit of a perfectionist, and that is just a struggle for me when I'm not in control of the situation at all points. Yeah, that I don't. The notion that other people can compromise on their standards, and you're then a part of that. That's something that, I definitely struggled with. So yeah, that I don't miss at all, and something I try and instill in everybody that works with us now.
Okay, yeah, I like that a lot. Last one, what do you think sets apart successful e-commerce entrepreneurs from those who give up, fail, or never get started?
I think it's the double feet thing. I think it's just jumping in, and you kind of have to trust that you will figure it out as you go, and that's kind of part of the journey. It's a rite of passage. You are meant to fail a lot of times until you get it right, and that's part of. I think a lot of people they hit their first hurdle and they're like, okay, give up and going back to whatever I did before, because I think that it's very easy to get suckered into the success stories you see online. And one thing you have to keep in mind, I keep in mind, is for every one article you read, or somebody that's done extremely well, there are like 999 other people that didn't necessarily do well the first time round, and then a subset of those persevere and keep going and kind of get to where, and maybe supersede the person that did well, that you originally knew of. So I think that there's a lot of kind of value in failure, and kind of starting over and continuously growing over time. Over the last 12 years, I dread to think of the amount of things that we tried and didn't go in the right direction. But then it's good, because then not to try things again in the future. where you get stuck is if you fail and then do the same thing again a year later, forgetting you did it before. That's where yeah, it's just pivot, innovate, etc. But yeah, I think that people who have a this is my exact plan, this is how the plan has to go, and I'm very strict on that. I think that that mindset can trip you up a bit. I think that it's meant to most of the people we work with, the business we're selling for them isn't their first business, it isn't their first idea, and frankly they've probably pivoted it a number of times before getting to a stage where they want to sell. So I think that's part of the journey, and should if you're in that stage, keep going.
Excellent. Very, very good. David, do you want to wrap up the show?
How can people get a hold of you?
Well, so our website is probably the best place, fbinternational.com. I think that's all the details are up there, as well as we just published our first half 2021 market report. So kind of really diving into a lot of the data around what these aggregators are up to, where the demand is, where the multiples are, etc. That'll be plastered on the homepage as well. So that's the best place for resource.
Very nice. Very nice. Well, thank you for being a guest on the Firing Man podcast. And we'll talk to you soon.
Thank you.
Yeah, appreciate it, Ismael.